Hey traders, happy October. Welcome to Charts and Coffee for Friday. Great to see everybody. All right, so we have the first day of the month, which oddly still feels like the last day of September. And we're looking at a lot of markets that are beginning to start a little bit of a transition to definitely not, again, I think the most important thing is to in a market that's beginning to transition to potentially chop. And this is jargon that I've been trying to ditch this year in 2021. And I find myself doing it and I realize, Rog, it's not really the way to think or communicate the market movement. Is we cannot think about the markets as a general concept. In other words, to say the markets are weak isn't necessarily accurate. So we want to be really specific to the sector. We want to be really specific to the index. So, that's the first thing to think about. We don't want to broadly just sort of paint all sectors, all stocks, all indices with the same brush, which is, oh, the markets are weak. That's number one. So let's be specific. Where is a downtrend more visible? Where is there potential for weakness? In a relative outperformance conversation to the downside, where is there better structure that's bearish? And it starts with the Dow. It does not start with the S&P. It does not start with the NAS. In fact, if I want to look, think of it this way. If you're looking to get a knockout punch, are you doing it in the first round? Well, it better be a really good hard punch. You're better off doing it after a few rounds where your opponent's a little bit, wobbly. And so we look for the wobbliest market. They're all in broken uptrends, but broken uptrends are not automatically downtrends. So those are some general concepts to keep in mind. And this is where, in modern markets, we're so lucky that we can start to dial that analysis into specific sectors. This is where ETFs are absolutely going to give us an amazing edge in the accuracy with which we can deploy our capital and take advantage of weakness. We don't have to think broadly at an index level. We don't even have to be as granular as a stock, although sometimes that will be great too. But when you're looking to really start to fine tune where the weakness or maybe eventually where the strength, let's not all just kind of jump into the bear camp. Where might there be resilience? Again, you're going to find that very likely at that sector level when you start to, take a look at the individual ETFs and say, wait a minute, can I find some resilience in another corner of the market? And, it might be individual to the sector. So that's where the ETFs are powerful. That's where a lot of my attention is going to be right now. And if you checked out the free video from last night over at the Simpler Trading YouTube channel, you'll see we did a deep dive into index sector stock, Dow, XLI, Honeywell. So check out that process over at the video. And, if that then resonates, right? And I know that, every strategy is not something that's going to resonate with everybody. But if you're thinking, Rog, that makes sense. High concentration weighting, understanding sector importance, and then understanding stock importance within that just makes sense. It's going to give me a better watch list. It's going to give me a better idea of what's happening in a more accurate and defined way. On Wednesday, we're going to dive a little bit more into this on the 6th, which is, my gosh, right around the corner. So next Wednesday, 8 p.m., mark it on your calendar. Let's dive into the questions. Great to see everybody. Good morning. Good morning. Hey there, Jimmy. Low? Sure. So taking a look at LOW, kind of expensive options. So you bring up a good point, Jimmy. I don't mind pricey options. What I do, so Trish and I were talking about this yesterday. A lot of you know I love my blue light specials, right? Straight from my youth, little blue light spinning in the middle of Kmart, right? I think we all know sort of what that means. There's a deal to be had. And usually it also tends to be a lower cost option. What's low cost? What's that line in the sand? To me, there's definitely a line in the sand between, say, a $10 option and under, over 10 and under 10, $1,000 per call or put. And then there's another sort of line I look at, which is about $5,000 to $7,000 or $5 to $7 per option. And then you could bring it down even more to, not 5 to 7,000, $500 to $700 per option. So at 10 points, at 5 points, at 3 points. I like to look at things below 5 to 7 points, at or below 5 to 7 points. And the reason for that, and the reason for the emphasis on ETFs, the reason for the low cost preference is not a small account mindset, but rather a scalable mindset, which is, yeah, right now my account might be smaller, but if I practice the right process, it's going to grow. Do I have an approach that's going to grow with that? So when I'm trading a $5,000, $50,000, $500,000, $5 million, can I still deploy the same risk management strategies, entry style? And you really should. I think having traded both, I've traded a 4-figure account at 15. I had $1,200 I started with. I've traded, 5, 6, 7-figure accounts. And I don't trade them any different. I just trade more when it gets bigger. And I think a lot of traders think, oh, when I have $1 million account, I'm going to trade differently. No, you're actually not. Not if you've honed in the process on the path there. Okay. So I love that you mentioned low cost options, and it always gives me a chance to talk about scalable mindset and why that's so important for us as traders. So yeah, low is above the 55. It's kind of inside the wave, which is why the candle is still blue. We've recently transitioned as of September 28 to a more sideways market, and it's buyable. So this is where we would take that next. We're at a stock level, right? So then, of course, Jimmy, I'm sure since you're following that sector secrets mastery process, right? What do the other stocks within that ETF? Remember, low is going to be in a couple different ETFs. Where is it in that relative outperformance measurement? But yeah, I do think it is interesting. The only thing to keep in mind is this is Friday. The psychology of the end of the week is very different than the psychology of the beginning of the week. And if we start, and let me give you all a figure to look at, and I don't have my toss running, but let me see if I can do this. I'm going to restart my toss here this morning. You want to know where that 5% level from the highs are, right? We talked about that in a previous video, because if we start to exceed that, and I mean at the broader index level, we're going to want to be very cautious about buys that we might think about taking into the weekend. So keep that in mind. That is going to be something that's going to affect us all across any sector, across any stock, which is this idea that if we cross certain, and it's a psychological threshold, that 5% is not technical, it's psychological. And if we cross that psychological threshold, that could bring a lot of grief to the markets come October 4. So which is Monday. So let's keep that in mind. All right. So I did want to show you what that looks like. So let's open up the daily time frame here. And I'm going to go to, for example, the ES. And do I have it running right now? Oh, I do. Okay. This line, right? So 42.48. 42.48. Yeah. Keep an eye on that level on the ES, 42.48 level. And you can see, we're kind of in that zone. Keep an eye on that. I think it's going to be one of those levels that could be really important to the downside. All right, moving on. And nowhere is there a month that historically just has this other shoe is going to drop type psychology than October. And remember, if enough people start to get bearish, worried, concerned, panic because of what we think October can be, remember, a lot of market movement is very self-fulfilling prophecy. All right. And let's see here. Keep this, and I'm trying to make sure we have the high here. Keep this low in mind for sure. Now, the way we can play this with a little bit less risk, and again, we talked about blue light specials, right? I love that scalable mindset. But on the other side of the blue light special, we have the Gucci trade, right? So yes, there are going to be certain trades where, yeah, we can trade more expensive options. And there's a number of ways we can do it. We can still bring the scalable mindset to the trade. We can still say, all right, well, how do we budget out a Gucci trade? All right. So we have blue light specials on one end, we have Gucci on the other. I just want everyone to be aware that the cost of the option does map to risk to your account, which is why I think it's so important that someone on this side of the mic be really, really clear about costs being a factor to risk. So if you're wandering into a Gucci trade, if you're wandering into booking Google, higher cost options, Amazon, you want to understand this is not necessarily going to scale in the same way for different size accounts. Now, can you make it scale? Sure. That's where multi-leg strategies will make sense. That's where, I have a specific way I play a call vertical. We have specific timing for put credit spreads, and that's where we can, fine tune that affordability on the Gucci side of the option spectrum. All right. So next question. Great to see everybody. Thank you. Good morning. Good morning. Yeah. Hey there, Tim. Thoughts on XLK into November and December? Well, I'm going to follow the trend. And right now we don't have a trend. So if you ask me what's going to happen in November and December, we got a dip on 920. Well, we had a gap on 920, right? That was the Evergrande move. And that one, I will say, that dip stopped out my aggro and my moderate. Talk about scalable opportunities. And I took small paper cuts on those. But our conservative survived that move and was ultimately able to move higher from there. So, just another reason why, whether you're on the blue light special spectrum or the Gucci spectrum, that scalability is really, really important. So, as far as XLF was the one that also got aggro and moderate. But anyways, we want to question tech, right? I mean, if you want to know what's happening with tech, let's look at this on TradingView. Look at TXN. I will actually be a little bit more futures oriented, and I'll look at ZN. Now, this is where I want to remind everybody, ZN has been moving lower. It just started to embrace a double red. But when you squeeze in where we are on ZN and you look at all these lows, this is the daily 10-year futures contract. You can see some of these lows here, but it just looks ugly, right? This is where, and it's very rare, but this is where all of a sudden you step out to a weekly and you look at, well, why was that level bouncing? Look at the way propulsion was in play. I would not just say that ZB or specifically ZN is circling the drain. I would not go there quite yet. So definitely weak on that daily, that weakness in the ZN futures. That's what is the inverse direction, with TXN moving higher yields and ZN moving lower. But if ZN bounces off that 200, TNX could then find resistance at its 200, right? And this is all on the weekly. I don't dive out to the weekly often, but when I do, like the Dos Equis guy, I want to do it so I understand what some of the obstacles to the up and downside may be, because sometimes things on a daily look very wonky. Like, why is this something that we need to be concerned with? Why is that showing a stall? And it may not be apparent on a daily, and yet you step out just a little further, kind of akin to climbing a little bit higher up the mountain and then looking down on everything that's happening. You get football tickets, right down on the field, and you get football tickets in the nosebleed. They both have their pros and cons. And, sometimes it's better to get that higher view just to see how all the pieces are moving. So, question tech. Absolutely. Absolutely. You want to question tech because ultimately what you have is that yield. And that's what I was mentioning earlier. And I love that you asked the question kind of from the sector point of view, Tim, because yeah, you're absolutely right. XLK might be one to put on the sidelines. And we could go to XLC, which looks marginally better. You can go to XLY, which looks better yet. So all of a sudden you look at NASDAQ as the whole and say, wait a minute, I need to dive into the NAS and see what's going on inside of it. And then you're right. I think I would avoid XLK, which actually means I might avoid Apple and Microsoft just for a bit as well. All right. Okay. Next up, how does the VIX impact my options trades? So you're absolutely right, Mark, in that volatility, whether it's the VIX or implied volatility or just price movement in general, it definitely affects the price we pay or collect in terms of premium. Specifically, the VIX, I really don't spend a lot of time, and I know this sounds like heresy, but I'm a proud technical heretic. I don't spend a lot of time with implied volatility. I don't spend a lot of time with volatility measured by the VIX. In fact, I don't think the VIX, with where it's at right now, is really all that helpful. When the VIX is helpful, it's typically on the lower end of the range, heading up, showing that we're increasing in volatility. We could see weakness in equities. I think that better, more useful end of the VIX is the lower end, the support oversold end of the VIX. And then specifically to IV percentile, historical volatility, etc. Mark, I look at it this way. I never want to, well, we always are going to pay for some volatility, but I don't want to pay for too much. How do you know you're paying for too much? If your trades are constantly having to get filled at the ask, you're probably, and it could be part of the strategy, you're probably paying for volatility. If you're buying calls when the market's moving higher, you're probably paying for volatility. If you're buying puts when the markets are lower, you're probably paying for volatility. And you're also, not coincidentally, likely using a momentum strategy. Nothing wrong with that, but always know where you are in terms of the amount of premium you're paying and how much volatility is sort of juicing that. So how does it impact? I think not VIX singularly, Mark, but volatility. Does it impact my options trades? It absolutely does in terms of what environment I'm able to get, the kind of pricing that I want for the option within. So it does impact volatility, does impact. I think volatility is the option secret, not so secret. So thank you for the question. My thoughts on Qualcomm? Sure. So no, as far as, well, any idea with it? Gosh, you give me way too much credit. I have no idea when the chip shortages will end. And I know this is in a downtrend though. What do I know? I don't know what the chip situation is. I'll let people far smarter than me do that. I do know when I trade what I see and not what I think and not what I feel, right? When I trade what I see and use my measure, when you're a diver, when you're a pilot, I don't know if any of you have scuba dived to a depth low enough where you start to get nitrogen narcosis. It's akin to having a little bit of a buzz underwater. Your judgment is impaired. And they always say, look at your gauges, because when you start diving, say, a vertical wall, which I really enjoyed doing in my youth in Bimini. There's a big continental shelf where the plates meet in Bimini, and it just goes straight down 3,000 feet. And, of course, we're not going down that deep, but we could be well into 180, 190, 200 feet. And at some point, you might get a little nitrogen narcosis. You have to trust your gauges because you're at a depth where you think you're going up, but you might be going down. You're at a depth where you start to really question your judgment. So you trust your gauges, right? That's definitely my approach to the markets. I have gauges. I have my 200. I have my JT. I have my red. So what do my gauges say? I don't know about the chip shortage situation. They can't answer that, but I know I'm south of the 200. I know I've got double red. I know I've got a steady string of red grab candles. I know I've got 8 exponential moving average propulsion dots sitting on top of price. Those are the things that I know, and all of that just maps to lower lows. So until I get a bottoming pattern where once again I'm trading what I'm seeing, and what I'm seeing is then potentially a, say, 1, 2, 3 a transition to a yellow JT multi. When the gauges change, then I can change, what it is that I'm thinking about the market. So when I trade what I see, what we see then, most traders, believe it or not, even experienced ones, they start going by gut, which is very hard to measure. They start going by, well, I feel, I think. Start with what you see and then let that affect your opinion, especially in the environment we're in right now, especially when we're in the environment right now. So heads up, and just be aware of, this is Friday. Be aware of where your individual stocks, indices, sectors are in relation to what one of my former students called a sanity check. I thought that's a brilliant name. Where are we in relation to the near-term highs? And keep an eye. I think that 5% is very much in play. So if we don't bounce, remember, around that 5% could be where the switch is flicked, right? Which would not be a good one for a Monday panic. So today is going to be very telling, especially the last hour of the day. So again, I'll be with you all in the options room and in the futures room for the last hour of the day. We will take a look at our sanity check, and that's going to be a great way this last hour of the day to prepare for the webinar coming up on Wednesday. All right, be good to each other. Thanks as always for being a part of Charts and Coffee, and I'll see you all either in the rooms later on today or on Monday. Be good to each other, gang.